Well, as I said before, the market has pivoted from focusing on pricing assets correlated to inflation to now pricing assets relative to an economic contraction and the potential for a recession, which I think is a 2022 conversation. So, you go back and you think about the post-World War II recessions, there's been 12 of them. And I think the focus is on not so much price being your enemy, but time being your enemy. Think about the median decline in those 12 recessions, 24%. Well, we went down peak to trough 24.5% for the S&P on June 17th. The average length of a recession, 10 months, the longest being 18 months back in 2007. And think about the multiple for the S&P. I heard Josh mention that. It contracts by a median of 21%. So we've done that. So now if you kind of look forward, you think to yourself, all right, if time's the enemy and we've endured much of the price damage, and now we're thinking about an economic contraction, what comes back into favor again? And that's a growth strategy. And that's a quality growth strategy. And looking at where the NASDAQ is and seeing the support today from growth, I wouldn't be surprised if by the end of the day, you're talking about a NASDAQ that actually goes green and stays green, because investors right now are now returning to prioritizing growth at a reasonable price because they're understanding you've got an environment where we're going to see a growth slowdown.
All right, Brent, over to you. I mean, one point I want to bring up is that the 10-year yield, it's really fallen. It's below 3%. I believe that right now at about 2.8%, which really helps out a lot of these high growth stocks. Is there something else causing these to rally? Again, Roblox up 10%, DocuSign up more than 4.5%, the cloud computing ETF up over 2.5%, really bucking the trend on the market.
Well, so I think you've seen this basket of names, like Zoom is one of them, Roblox, Unity, not all of them, right? And so you're starting to see some, discernment between the Robloxes and the Zooms versus the Pelotons, which, is probably not going to recover. But this is really textbook. I mean, you saw this when the tech bubble burst. Those names that went down 70 to 80% and then survived actually outperformed in that second year. They outperformed financials and value names. So I do think if you go back and look at history, that's somewhat expected. And what's interesting, like on a Zoom, Zoom hit, I think, 85 a while back, and like Zoom and Roblox, it keeps making higher lows. And so I think that's a really healthy sign to see these companies that have gone down 70 to 80% just kind of quietly creeping higher. Today is definitely not a creep, it's a jump when you have them up 10 and 5%. But I think, though, as the narrative changes, and I do think next year we'll be talking more about rate cuts than rate hikes, the companies that have sustainable business models, like a Zoom, a Roblox, I think will continue to move up, have the potential to move up in price, and like some of the ARK names or ARK itself will catch a bid versus what I think investors need to know. Right now, consumer staples, which has been a really popular place to hide out, it's very textbook when you're going into a late stage of recession. Consumer staples trade at a higher PE than tech right now. And so I think that you're starting to see this rotation, and you see consumer staples are down, whereas we're talking about right now, tech is actually having a pretty good day net.